Local stories, local voices. We're localwebradio.fm.
Welcome to Sound Investing with Byron Striloff, Senior Investment Advisor at CIBC Wood Gundy, and recognized by Vancouver Magazine in its selection of top wealth makers in Vancouver for 2013. And now, here's your host.
Well, yes, this is your host, Erik Reynolds, and I'm here with Byron Striloff, Senior Investment Advisor at CIBC Wood Gundy. And today we are talking with Byron about the Canadian and U.S. economy and discussing the U.S. and their economic recovery policies, how the stock market affects the economy, and what retirees can be doing for long-term success. Now, before Byron joins us, just a reminder that if you have questions or require assistance, you can reach Byron at 604-535-3700. Again, that's 604-535-3700. Well, hi, Byron. It's great to be talking with you again today.
I'm happy to be here, Erik.
Well, let's talk about everybody's favorite topic, the U.S. economy. Well, Byron, I see we're going to talk about the amount of debt the U.S. government has created as their policy for an economic recovery. Now, do you think it's a good idea?
Well, I'll tell you, the jury is still out, but it has been a conversation that I've been having with my clients over the last few years. What I see developing is a clear mismatch between what the government deems best for the public and what individuals are choosing as best for themselves. And what I mean by that is in the U.S., the government has made debt the recovery tool, and it is the center of its economic policies. They view credit and debt as the lifeblood of their economic expansion, and they've worked hard to make sure that there is enough credit available at low interest rates and plenty of money to go around to fuel, a recovery. But the problem is, consumers are not taking the offer. In fact, since the turndown, U.S. government debt has exploded by many trillions of dollars, whereas the financial sector has contracted by trillions of dollars. So almost 4 years after the recovery has officially begun, consumer debt is going down, and that becomes a problem. Because this is exactly what the Federal Reserve and the U.S. government do not want. What they would like is for consumers to take on more debt and use the proceeds to finance purchases of, almost anything.
So if the consumer is not borrowing more and more money, which seems like a good thing, why is that a problem for the central bank?
Well, here's what that problem looks like. When we borrow money, it's a form of money expansion, because when we spend the money, it's new money that enters the system. Now, there are only two ways to deal with the debt. Either you pay it off or the bank or lender writes it off. Either way, money leaves the system, so we shrink the money supply. That causes what the Fed is trying to avoid at all costs, which is deflation. Why? Because paying back loans and shrinking the money supply, or by doing that, we lower overall demand, which puts pressure on merchants who then cannot raise their prices and end up laying off or simply not hiring more workers. So we have a situation where we have less money chasing more goods, so it becomes a downward cycle and leads to a slowing economy, which is not what the government wants. Now, since the Fed cannot force people to borrow, Americans who were scared by the financial crisis during 2007 and 2008, they're paying down debt as best they can. And what they, or the Fed, have done to encourage new debt is obviously lower interest rates to make it cheaper to borrow. Plus, they've printed lots of new money, which also cheapens existing dollars in the system. So if we think about it in a rational world, both of these policies really should have convinced investors to splurge and spend all of their saved dollars to make better use of their funds. Why? Because they are earning no interest to speak of, and of course their savings are dwindling in value after inflation and taxes. But the interesting thing is that people haven't, and I think for good reason. When when people feel uncertain about the economy, and that probably is more towards their particular jobs, their individual jobs, paying down debt instead of taking on more, that serves our individual purposes, which for the majority of the population, they're preparing for retirement. And that brings us back to the mismatch. The efforts of the government to grow the economy versus the efforts of the individual to prepare for retirement, and of course that kind of meets smack in the middle of the messy economic reality that we have today.
Now, but Byron, I thought that the economy was getting stronger. I mean, I've always thought that when the stock market goes up, this is reflecting a stronger economy. Your comments kind of make me think that might not be the case.
Well, I'll tell you, you're absolutely right on that. Not all rising stock markets indicate a recovering economy. Here, let me try and put into perspective why this market is different. First of all, we have had unprecedented economic stimulus from all of the major central banks in the world. And after 5 years of pumping money into the system, money tends to go where it'll make the best return, and that has been the stock market and the real estate market. So the super low interest rates since 2008 have actually helped inflate these markets towards elevations that have many economists concerned because they look like bubbles are forming. And that, of course, is the interesting thing because very few people are worried about that. In fact, most are actually quite happy at the rise in prices. Now I get that. I understand their motivation. Bubbles benefit everyone because people make money by doing nothing other than going along for the ride. So no one wants a bubble to end, and the rationale becomes, oh, it's okay because this time it's different. So the biggest difference I see from previous bubbles, like, for example, 2000 and 2007, is during those periods there were strong fundamental demographic and economic trends that were behind them. This one is central bank driven, and it doesn't have these trends. So it's artificial in the sense that markets are only advancing because of stimulus and borrowed money. And in a normal recovery, the debts and inefficiencies and imbalances from the previous boom would get washed out and corrected, and then the economy would be able to rebalance itself. And the thing is, the economy wants to correct, but the Fed is preventing it because corrections are painful. Politicians have a hard time getting reelected when housing prices and stock prices are falling. So it's much easier to stimulate, keep interest rates artificially low, and borrow more money in the hopes that things will turn around.
Now, Byron, I have more questions for you, but we are up against a break here. So let's go ahead and hit the pause button, and we will be right back with Byron Striloff, Senior Investment Advisor for CIBC Wood Gundy. And when we return, we'll be discussing the stock market and what retirees can do despite the economy. We'll be right back.
More Sound Investing with Byron Striloff after this.
Buying or selling a home on the Semiahmoo Peninsula? Catch up on local market conditions on This Week in Real Estate with Lance and Connie Marples from Sutton West Coast Realty on localwebradio.fm.
If you're struggling with a dental or oral health issue, be sure to catch the Healthy Smiles Oral Health Show with Dr. Norm Ickert on the Health Channel on localwebradio.fm.
Shopping for the lowest mortgage rate? Looking to refinance?
Catch the Mortgage Newscast with Jared Dreyer
On the Business Channel.
on localwebradio.fm.
It's now time for more Sound Investing with Byron Striloff, Senior Investment Advisor at CIBC Wood Gundy.
All right, we're back with Byron Striloff, and we're discussing smart choices for those people looking to retire. Now, Byron, here's my question. If our higher stock market is not connected directly or the result of a recovering economy, aren't people still better off financially with higher stock prices?
Well, you would certainly think so on the surface. And I do know that people point to the recent highs of the stock market as proof of the recovery, and therefore, we can all expect the return of rising consumer spending. But that ignores one little sticky point. Aggregate wealth has recovered completely, no question. Individual wealth has not. Now, the majority of U.S. wealth, in particular, is based primarily on financial assets like stocks. Americans or populations in most other first world nations, for that matter, they do not share equally in stock market gains. These are heavily skewed towards a much smaller percentage of the population. So what I'm saying is that the average person is not benefiting from the run-up in stock prices. The main benefit is going to high net worth individuals, corporations, and financial institutions. And this is one of the reasons that I'm cautious about the stock market. We have a number of asset bubbles developing, or at best, prices that are higher than they should be because of all the money sloshing around the world, which has been injected by central banks, again, around the world to normalize or save the economy. In fact, the chart we have this week is an illustration between the tech bubble from 1994 and 2000 and the current bubble. And if you take a look at the chart, you'll see that the bubble, or the stock market rise that we're in today, we've had an even larger point gain than on the Dow in 2000. So that is a bit of a concern. We just have to be aware of that. And at the same time, we're on the downslope of drastically slowing demographic trends, which is a worldwide phenomenon, especially for the industrialized world. We have the greatest accumulation of all kinds of debt in history in the world. So historically, this has the look and feel of a stimulus-fueled asset bubble that is reaching maturity. And with rare exceptions, strong market expansions tend to last around 5 years, which is exactly where we are today. I think actually this month coming up is the anniversary. So in my view, after 5 years of a strong stock market recovery to all-time highs, this is a good time to look at your portfolio and ask yourself, how will you do if we revert back to long-term market averages, especially if you're retired?
Well, now, Byron, that's a good point. But let me ask you this. What should retirees or people about to retire be doing differently with the stock market at a long-term high and interest rates at a long-term low?
Well, that is the conundrum, isn't it? And that is a problem with no easy answer, Eric. Today's standard advice for retirees is to get out of stocks and into fixed income investments like bonds. I mean, the idea behind that is once you retire, you are dependent upon the income from your investments or the sale of your investments. So therefore, your risk tolerance is much lower, because if we have a market correction and you have to sell stocks at a low point, you're going to lose money that you can't easily replace. The problem, of course, is that one of the negative consequences of the whole QE program, which is intended to keep interest rates low, is that it hurts savers and retirees by keeping returns on safe investments so low as to be almost meaningless. So this has pushed many normally conservative investors further out on the risk curve just to have any sort of return, and many of whom do not really understand the relative risk to their savings. So the bottom line is, this will continue to be a difficult time for risk-averse investors who require income, and especially retired people who need a livable income from their RRSP and other savings. One suggestion I do have for listeners is to talk to your advisor and have him make your investment income as tax efficient as possible. Most people I meet are paying more income tax on their investment income than they need to, and if you can save 30 to 45% on your investment income, that's a big increase in what you have to spend.
Now, Byron, before we get out of here, let me ask you one more question. Now, how do you feel the winding down of the stimulus programs will affect the economy and financial markets, not only for the U.S., but for the world?